this to us. That's very important for us to educate the clients. I do perfect recipe for retirement series to make sure that the legacy is maintained and the clients learn how to live a good life and how to invest in the stock market. You don't need an introduction, but just for the audience sake, after doing accountancy as a qualified chartered accountant, and then the cost accounting, and then from IIM Calcutta you have passed out. The books have been written on you. A wonderful book you wrote, and then I think the new book is also going to come. So I think you're someone who has been throwing a lot of positive light on the stock market in India, and I think in particular the micro, which is how to invest in the equity. So I will be keeping this session in roughly 3 parts. One is the equity investing. I think that is the most important thing we all want to learn. The second part I would focus more on I think you're also on the board of a lot of this billionaire promoters and the CEOs take advice from you for their businesses. So that is second part I would like to. And then third part we'll talk something on the reflection of life. So the first question I have is a very simple question, that if somebody wants to, as a newcomer, want to approach equity investing, how should he go about?
First is to start as early as you can.
Okay.
Because time is a friend of good equity investing. Secondly, time will allow you to deal with the mistakes you will make and will have chance to overcome them and benefit. Secondly, investing has to be a love, has to be a passion. It can't be just the work, or it can't merely be the route through which you want to make money or build wealth. While those are important in themselves, but wealth, money that you make out of investing are all byproducts. To my mind, investing is actually a great source of learning about so many different branches of knowledge. I mean, investing really is like a lattice work where so many different branches of knowledge impinge on each other and create a larger learning system to be developed. Thirdly, investing teaches you the virtue of patience.
Yes.
In the world of hustle and bustle, and in the world of social media, gratification instantaneously at the expense of long-term real elevation is something which is natural. But equity doesn't function that way. Equity requires you to learn and practice the art of patience. Because it is only with the patience and the learning that the real outcomes of a compounding nature occur. Fourthly, I would say the deep appreciation of the idea of compounding.
Yes.
Compounding doesn't come naturally to the humans because humans think in terms of incrementality, arithmetic changes. Compounding is geometric progression, and humanity doesn't easily deal with geometric multiplication as an idea. A simple idea like compounding, that doing something which in itself may look simple, but do it over long period of time with non-wavering focus, where you keep doing the same thing again and again and again, such that a simple thing done repeatedly results into an outcome which is disproportionately large compared to that each incremental outcome. This requires ability to think long term, ability to appreciate patience, and ability to understand the mathematics of investing, that true part and the true power of investing is geometricity and not arithmetic sum total. Finally, I would say investing requires you to be a, so to say, reasonably contented, happy individual within. Because without that, there'll be dissonance, there'll be temptations, and there'll be shortcuts. When the true investing is imbibed, it typically will make you a more, hopefully, calmer, kind of more serene individual, more reconciled to within, and somebody who is aspiring to win the game, because ultimately winning the investing game is an intellectual gratification. But doing it right is even more important than getting it right. And therefore, getting right results in a right way is the ultimate fruit that you earn out of investing. Finally, I would say you're a trustee of your wealth.
Yeah, custodian.
Whether you do it for others or whether you do it for yourself or for your family. Ultimately, the wealth that you manage, you don't have any unhindered right on that. You have a duty to optimize it, and in a fair way, in an appropriate way. Even for your own money, you don't have any liberties.
True.
And you do not have any laissez-faire mindset that I can do anything that I want. That discipline is something which is importantly learned. Therefore, I would say the science part of investing is how you start with it, the science and the myths of investing, whether understanding character of business, character of management, size of opportunity, earnings growth, pattern, quality of growth, understanding value, and then applying it in the context of price. All of these, to my mind, is more in the realm of mathematics and the science of investing. Essential, but not enough. What is even more important is the art of investing, the language through which investing expresses itself, which essentially are 4 elements to my mind: discipline, character, the temperament, and the wisdom. And each of these in itself more important than, I would say, the science part of investing.
Okay.
Discipline to do right and to do not only right, to stick to quality, but also to value the economics of the investing by buying with some margin of safety. Not to get distracted is the fundamental important art of investing, the discipline. The character, what I mentioned, not only to get right results, but through the right way. And that is absolutely non-negotiable because it is not sustainable otherwise. The third part, the temperament. The markets are not designed to make you win. You have to get a victory by not falling into the charms of the market. You have to find your way around and navigate. Markets are probably designed to make you fail or to make you succumb. But if you do not, and if you really play the game well, then markets are actually bountiful and generous and they reward you handsomely. And finally, the wisdom, which is a much larger virtue than intellect. Intellect throws the light. Wisdom shows the path. Intellect tells you the reasons and what to do. Wisdom gives you the enlightenment to pursue it for a long
Beyond
period.
doubt, yeah.
And therefore, I feel investing is a lifelong pursuit. It is not merely to make you rich or wealthy or to get you satisfaction of attracting name and all that, while all these are important in themselves.
Yeah.
But I would say these are byproducts. The real power of investing is the learning it gives, the intellectual gratification that you get when you win the game in a right way, the trusteeship responsibility that you discharge in a very disciplined way, whether for your own money or whether for somebody else's money. And finally, the true power of the investing comes that it makes you as an individual overall materially better and different than merely your intellect could have accommodated. And therefore, I see investing is a continuous school in which you learn right till the end when you hang your shoes. And that's a great joy, in my opinion.
Thank you, Baba. Very, very good answer. And so, Bharat, now I'll go a little bit specific. And the price to earning, I think you have spoken many times about it. Price to earning is a very flawed way of looking at the stock. What do you think is the right method to look at a stock in terms of valuation? How should we also judge price to earning? If we have to judge only price to earning, how can we go about it?
The reasons why price to earning is not very representative are many. Price to earning is immediacy, that price today and profit either tomorrow or day after or third day. And business is not about 1 year or 2 years of earnings, it is a lifetime of earnings, and therefore it is a very near-term bias. Secondly, price to earning is about profits, but really the value is the cash flow, and therefore price to earning doesn't really capture. Thirdly, price to earning doesn't have concept of time value of money, because given the fact of immediacy bias, it doesn't really capture the distance. And distance means time value of money, because the rupee today is not the same thing as rupee tomorrow and day after. And therefore, without time value of money coming into the play, you can't really capture the value. Fourthly, price earning multiple doesn't encompass the idea of capital efficiency. And capital efficiency has a deep impact on the final outcome that you get. The quality of the growth, not just the growth. Essentially, you really make two very important returns, apart from a third return due to margin of safety. But the two most important annuity returns that you make, one is the future earnings growth, and second is the quality of growth. And both of these are annuities. Future earnings growth by definition has to be a positive number, because if it is a negative number, then there is no case for investing. But the quality of growth which sits on the top of the earnings growth can be positive, can be zero, can be negative, or can be deeply negative. And therefore, if the character of the growth is superior, apart from earnings growth, let's say on a per annum basis that you make, you get an additional annuity which sits on the top of that earnings growth, and again it is a compounding annuity.
Right.
So let's say earnings growth may be 12% per annum over, let's say, 15 years.
Okay.
But the quality of growth may make it that 12 into 14%, 15%, 13%, 16%, depending upon how superior is the character. If the quality is even, then there is no premium added, 12 becomes the 12, and all that you get as an outcome is the underlying growth. But when quality is inferior, that annuity of the quality may be negative. Therefore, 12 minus 8 or 12 minus 4 or 12 minus 5 may be the outcome. And when quality is downright corrosive and despicable, then the negative amount is so high that a 12% growth may result into minus 2%, minus 5%, minus 10% compounded negative as an outcome. Therefore, that quality of the growth part is something a PE can never capture. That gets captured in the character by capital efficiency, the return on capital employed, the return on equity, the pattern of the growth, whether early or late, whether even or uneven, whether relatively more predictable or an outcome which may happen. The two outcomes, the same outcome may happen, but one which is more predictable has a greater value, even if the final outcome is the same. Similarly, something which is more certain is a greater value. Therefore, quality gives that durability, that longevity, that solidity, and it prevents businesses from disintegrating, to be able to deal with the challenges and the vicissitudes of the environment. Therefore, that second premium that you get through quality is a very powerful and very important return that you aid. If that were not to be the case, you will never find businesses which have grown at X percentage, but the returns have been X plus Y percentage over very long period of time. I mean, if you look at Asian Paints over 30 years, the earnings have grown at about 16%.
Correct.
But the market returns over a 30-year period have been about 20 to 23%. That 6-7% extra is a staggering amount of compounding additionality that you get. And of course, the final part is the margin of safety, which is gap between price today and whatever is your value jet today. And that difference is a one time, but may play out over a period of time.
Of course.
But really speaking, the value of a business can, in simple terms, is nothing but sum total of future profit. And that profit may need to be modified as cash flow. Because it is in future, therefore time value of money comes into the play. Because there is a future involved, you need to estimate economic life of the business and not just the physical life. The character of the growth, the capital efficiency will decide the quantum of growth converting into quantum of the cash flow, and therefore you need to judge that too. When you have all of these put together along with the management quality judgment and the size of opportunity judgment, there you have then a model where value is some kind of a sigma or sum total of future cash flows or incremental cash flow, duly tempered with the qualitative parameters of the capital efficiency and discounted at an appropriate rate to today. And that value is the fact that it may be harder to compute and constantly requiring you to monitor and change. It doesn't mean you take an easy way out by price earning multiple. So it is harder to judge that way, but that is probably the more realistic and logical way to do things.
Okay, that's a fair answer. So now let's go further, and I think we were discussing in the earlier ROC and the margin on the sales, and I think that yesterday also one company you presented. So assuming that ROC of two companies are same for the last 10 years, and the sales growth is 10% roughly, should we look at the earning margins? Is it really important or not? For example, in some industry, we are happy with a low margin company with a good ROC because it could be a very good growth engine. In some industry, like I think Asian Paint must be at least 20 plus profit margin. So how do we look at the margin? Is it really important or not, or is it industry specific?
Well, margin, I would say, is only one of the levers. The capital turns, both of the fixed asset and of the working capital, is another factor that works in favor. A business may have 8% margin, but if the capital turns are 10 times, then potentially the return on capital employed could be 80%. The other business may have a EBIT margin of say 25%, but if the capital turn is say half, then the return on capital employed is unlikely to be more than just the 12, 13, 14% type. I think the key critical benchmark is the return on capital employed. It encompasses within that everything. The margin, the fixed asset intensity and its turnover, working capital management and its efficiency, and therefore working capital turns. All of these finally subsume themselves in the value creating metric called return on capital employed. Therefore, other things being equal, obviously a business with a better margin has a better outcome if all other things are equal, but they rarely are equal. Therefore, we have to take into account margins, we have to take into account size of opportunity, and therefore the estimate of the growth rate. And very importantly, we have to take into account the character of the growth through capital turns, whether of the fixed assets as well as of the working capital. I think it is the totality which is finally summarized in return on capital employed and eventually into return on equity, which is the benchmark for value creation.
Okay, fair point. I'll take a specific example. So Delta Corp, which is like roughly 5,000 crore market cap, and suddenly what happened? They got a notice of 23,000 crores. In this kind of scenario, I don't know whether, I'm sure it's 25 years plus you would have seen this kind of scenarios also, where you have no support, there is no way, there is no news from the court of law. What one should do if he holds this kind of company in the portfolio and this happens?
Well, I had to speak on specific thing like that because it is a challenge.
Yes.
I mean, if you think of it, ITC, a few decades back had a major staggering excise liability which cropped up.
Yes.
And it looked like as if the business will get drowned under it if that were to materialize. Of course, over a period of time it changed. Things became more amenable. They could deal with it legally. And now it sounds a bit like a history. Whether for Delta it is similar or it can be a doomsday moment, time will tell, difficult to say. But businesses which are socially relatively more, so to say, contestable and consumable from regulation perspective, where there are no other support in your favor. Those businesses will have that vulnerability. I mean, organized gambling or gaming, tobacco, for example, or casino like Delta that you talked about. The other crutches which can hold such businesses in crunch times may or may not exist, and that risk always remains with such businesses.
Okay. But the challenge in the value investing, where the the three legs of the stool is very simple, that the quality, growth and earning. Now, one very important thing is on the quality, earning and valuation is a valuation, and this businesses are never available cheap. For example, Asian Paint today also that above the PE of 50 probably. So there is a other way of evaluating the company if they are cheap is the free cash flow. So if the free cash flow yield is higher than the government treasury bond, and that could be a good entry point. Some of the investors have been saying so. So how will we on a quality company, how in a quality company we will decide to get in? Like we discussed in the morning, also the Indian stocks are pretty costly. I will just tell you from my experience in the US also, all these quality companies are still at P 30, 35, 40. And how do we go about buying these companies at the right price?
No, all three levers have to work, and there is no one-leg stool. Pure cheapness without growth is an exercise in self-limitation, because it's a limited game that you can play. Beyond that, there is no future. Growth without quality of growth being sound can be recipe for diminution or destruction. And growth and quality, while both are needed, have to be bought at a price which is sensible, where you're given less than what you have got, what you have gotten out of that purchase. Otherwise, the economics is a reducing economics. And therefore, all the three have to play the part. The good businesses are unlikely to become mouth-wateringly cheap. But good businesses do become reasonably priced time to time. And that occurs virtually like a rhythmic cycle all along, where even best of the businesses time to time become relatively more affordable and relatively more attractive than the long-term economics would demand. And those are the those are in fact contributory and positive moments when you really actually optimize on purchasing some of these good businesses. But getting away from valuation is not an option. Ultimately, no great business, however good the growth may be, however strong the character of the growth and quality may be, you still need to buy at a sensible price, and it can't be at any price. Any price kind of definition is an exercise in definitely self-reduction.
Agreed.
Because ultimately, if the value is the middle point, and if you bought it on the left at a margin of safety, the value will compound with the time, because the rate at which you have discounted the future is the rate at which value will compound going forward. But instead of middle point and you buying here, you buy here, then this to this distance has to be reduced from the future compounding in order, and your returns will get reduced, if not rendered mediocre, when you overpay for a good.
So free cash flow to yield is also a good, free cash flow yield is a good parameter to get.
Free cash flow is the fundamental part of any DCF valuation that you do. So free cash flow, either it is summarized as a value today, and therefore the margin of safety percentage is determined, or free cash flow expresses a yield to the market cap, will give you some kind of a, so to say, alternative economics, that your risk-free rate of return is X, but if your cash yield itself is, say, equal or better, then future growth will make it much higher over a period of time. But that may or may not easily happen, and typically if the risk-free return is here in good quality businesses, the free cash flow yield is more likely to be the left rather than to the right. Therefore, then the growth at which quickly that yield will converge and overtake risk-free rate is important.
Right. Agreed.
And secondly, duration for which the growth will prevail is equally critical.
Okay, so that has to be seen. Yes, agreed. Now, cost of capital. So the one way is that I can look at the ROC minus the free cash flow yield, which is really easy to calculate. But in general, what do you think is the cost of capital's easiest way to go about for a business? What should be the cost of capital?
Well, cost of capital has two components. The cost of, for a business, it is the cost of borrowing and the cost of equity. Cost of borrowing is an explicit cost and tax deductible. Therefore, it is the cheapest source of using the capital. It is the cost of equity, which doesn't have tax deductibility, and it entails the risk. Therefore, expected return out of that equity component is much higher. It is the blended proportion of the two capital which will determine your weighted average cost of capital. That is as far as business is concerned, where ROC minus the cost of capital will be definition of economic value added, and that economic value added and compounding over a period of time will determine and give you a sense of the value. As far as individual is concerned, who has to make an investment decision, the important part is the alternate opportunity that you have. An alternate opportunity will be risk-free return and some perception of risk premium that you want in addition to that for you to take a risk because ultimately investing is optimization of risk and not elimination of risk.
Correct.
Because
Absolutely.
you can't eliminate risk.
No,
Risk
no,
is
not.
never zero. It is just that you blend it well where you minimize the risk and optimize the return so that the difference is in your favor. And therefore, that's more, I would say, individual is to the risk-free rate of return is a generic number which is available in the system. How much do you think is a risk premium that you want in addition? May probably vary with the person, the thought process, the logic and the rationale behind expecting X return or Y return. These are probably a bit more subjective, but I would personally anything less than reasonable double-digit cost of capital is a benchmark to be recovered would not adequately mean equity investment justification.
Okay. I think the last question we'll take on the investing side and we'll move it to the business side. See, what is the best advice you have ever received on the investing and you would like to pass on to all our audience and us?
Well, quality of a business is harder to judge, but a very, very important part of the final metrics. Markets tend to be more mathematical, investors tend to be more arithmetical, and therefore mathematics and science gives you a false sense of or false illusion of precision and definitiveness. But it is the quality which is very vital because quality protects. Quality protects the business itself from the business challenges. Quality allows business to become durable, therefore it allows compounding power. Quality allows you a peace of mind and allows you to be long-term invested in a business. When the business is poor quality, you are also on the edge. At every challenge, your mindset is to run out rather than remain or aid. And therefore, quality not only does what is important to the business, it does to your own mindset because it allows you to remain with a business long enough to get the full compounding power of that business. So I think typically monodimensional, mathematically linear modeling of growth equal to the returns is something which is easy to understand and assume, but greater dimensionality which comes from the quality is so vital.
Correct.
But it requires patience because quality may not give you immediate outcome and therefore it needs real patience and real conviction and belief. Of course, an intelligent belief tested by a due degree of vigilance that your assumptions are right and you're not getting carried away. But all of those makes it challenging to practice, but very vital to do so.
I think that even patience needs quality.
Absolutely.
That's a well said. So, coming to the life, who are the top billionaires who have influenced your life?
Well, I would definitely say Buffett, even more than many others. Because in my opinion, my perception could be wrong, but fundamentally Buffett is a happy individual, is my impression.
Yes. We all have that.
He's a childlike glee about life. He lives life fully. He is wealthy not because he has made a lot of wealth, but I think the wealth that comes from inner peace, the satisfaction, the calmness it gives you and the serenity it gives is something which is very, very attractive benefit of investing. Buffett symbolizes or appears to symbolize that tranquility, that serenity, that calmness. And to me, that is very valuable. The other part is the ethics of it.
Yes, that's the highest.
Ultimately, it is important not only to get the results right, but to get it through the right methods. And whatever one knows of Buffett, I think not just the outcome, but how of it also has been equally strong. Like they say, sadhan shuddhi and sadhya shuddhi, both are vital. The means have to be right for the end which is right, and it can't be one or the other. Good objective also must be achieved through good means, and therefore Buffett in many ways represents that integration of that basic ethics of healthy capitalism. Finally, I find Buffett more driven by the passion of it, the learning involved in it, rather than just the wealth accumulated or the riches that are acquired. I don't think he has any need for even a fraction of that wealth that he has made. Therefore, and given the frugality generally that he is known for, it's not as if his needs are many and means are much, much higher. It is genuinely getting a great outcome in a right way and to achieve it over a prolonged period of time. I think that is the beauty of overall success of Buffett. Buffett has gone through his own periods of challenges and difficulties and time to time revisiting what needs to be done again. But Buffett is a learner, and I deeply appreciate his calm demeanor through which he wants to keep being at it. The final part I would say is the discipline. I mean, whether the outcome of that discipline and self-restraint may not always be the most heartwarming one. Like during COVID, Buffett did seem to take a view that this is a formidable challenge, and he remained on cash longer than probably was in his interest. But his discipline is not necessarily to do the right thing only, while of course it is important. Discipline equally is about what you believe and what you do. The satatya between the two is vital. On that, I would say Buffett scores very highly. One area where I feel probably Buffett may or may not conceive and think from that point of view, maybe typical American capitalist, but I think the spiritual angle of building wealth is equally very powerful and very elevating one. On that, of course, like any other successful billionaire, Buffett also has given away much of what he has got. So I'm not even for a moment commenting on that. But the true integration of the philosophical spirituality in your end game of investing, maybe that is something that is an element Buffett may weave into. He's still young enough to do that.
In fact, if I may add something, in 2020 when he lost a lot of money in aviation, 50 billion plus, and the way he recovered everything, and I think that reminds me that we all will commit mistakes. And at 90 also he committed a big mistake, and the more you make, the more mistakes you will do, and it's a part of life. I think many young people do not understand that. So I think that's a very fair point, that over deliverance and under promise, like he says, don't even come to the equity market if you do not have a 10-year views. How many of us actually can say that to the clients? So I think that's a very valid point of your side. So we'll move it to the business, the live side. Bharat, 3 books, or let's say top books which we are waiting for your new book. Audience, the first book which is not printed, but feel free to reach out to us to get a soft copy. But which are the books do you think you would like to, or they have influenced you and you like us to read through and improve our life as well?
You mean in the investment?
In the investment, in the life, whatever top 3 you think.
On the life, there
all
are
interlinked.
so many. I mean,
I know you read.
it's an ocean.
Yes,
so
yes.
to name will be a long list of hundreds of titles, because I read on physics, I read on space, astronomy. These are my favorite areas. I love reading on biology, and adaptive part of biology to investing again is very important pedal. I love reading on philosophy, spirituality. I love reading literature. Even these days I read literature, and I read, even apart from non-fiction, I read crime books. There are some outstanding crime books which are like pieces of literature. I mean, there are some really beautiful crime fiction books which independently would look like pieces of literature. So there are many things to be enjoyed and to be
We didn't know this part of your life.
But on investing, I would say the books that have definitely left an impression. One of the earlier ones, Phil Fisher's Conservative Investors Sleep Well. I think it's a classic one, and the Common Stocks and Uncommon Profits, again of Phil Fisher. Both of them are very wise lessons in evaluating investment in its totality. William Burr's book, The Theory of Value, again is a very fundamental coaching material on valuation. Jeremy Siegel's book, The Stocks for the Long Run, again simple but very elegant one. Graham's ideas were shaped by the time that he lived in, the Great Depression era, and therefore many of it has been a bit more prescriptive and mathematical, and less of the ideas the way Phil Fisher books have been. But even after accepting the limitation of very formulaic approach of Graham to investing, the intelligent investor, or the seminal work behind the search of value is phenomenal, forever kind of grounding work. So all of them remain very powerful reminder of how beautiful investing can be, despite frequent and significant challenges that you witness in the journey over the period of time.
No, that's a very long list, and I think some of them I have to also read. You have been advising the promoters, which I read through. What is a common challenge you think that all these promoters or the CEOs go through? What is that one common challenge you think that our investors should understand in their business to take it to the next level?
Well, patience for the long term, to build it right rather than build it fast, is very vital, because ultimately nothing substantial is obtained till it is compounded for a very long period of time. Right. So even when there is a huge opportunity and all the capability, unless it is supplemented by vision of the long term and patience for that entire journey, the outcomes for the brightest people can be suboptimal. Secondly, the power of entrepreneurship. I always remain enamored of that. It is entrepreneur who has skin in the game, fire in the belly, ability to deal with the challenges and vicissitudes of the businesses without getting cowed down, He not only puts capital but also brings intellectual capital. He sees through the hazy, difficult period while remaining steadfast on the long-term destiny. And it's a very lonely battle because when the businesses are going through challenge, usually it is the leader who has to face the brunt and challenges. Like in investing, in tough times, investor is a very lonely individual because there is no succor around and there is no help. And given the grinding machine of investing the way it is, outcome is there every day at 3:30 as to how good or bad you were. And therefore, there are frequent reminders of how badly you did for a length of time for you not to succumb to the pressure. Also, you see, good value creation and good investing both require an ability to hold contrary emotions simultaneously without being torn apart by it. Therefore, you have to have faith, but you must doubt. You must have trust, but you must have skepticism. You have a belief, and yet you have a mindset to look for challenge. Ability to hold the contrary emotions simultaneously without making mincemeat of you is required both in a business as well as in investment. And without that quality, neither great businesses get built nor good investing gets built.
I think that was the gem of today's talk, that having the ability to doubt and also have the faith and drive the business. So I think the last thing we would like to know, if at all it is possible, your upcoming book. Anything, I know it must be a secret right now because it must be the publisher would have been finalized. Anything you would like to tell us? Is it a sequel of the last book, or is it not on the investing? What exactly you're writing?
No, it is on investing.
Okay.
It is containing probably my first book had a bit more of maths and
it was full of maths, if you allow me to say.
relatively less amount of English. The new book is much bigger version of the first one, but with far lesser amount of mathematics and far more amount of English. So pure English content in the book might be 3 times or 4 times the first book. But it is on investing and many other behavioral and characteristics and traits have been explored. Many other investment philosophical ideas have been explored. So,
thanks a lot for writing. Thanks a lot for doing this session. Ladies and gentlemen, Perfect Recipe for Retires Rich Series 29, Bharat Bhai. I think today's message, the quality, patience, building the long-term vision, and even quality of patience. This is important. Please like and subscribe our channel because these wisdoms are very important. And Bharat Shah is somebody who is like, I'll say, one of the Indian Warren Buffett available with us.
No.
And I'm sure he'll deny that. But I think we need to really read his work. We need to really watch all his videos and live that life to be a good investor. The whole idea is that you become a good investor with a minimum intervention on the volatility on the stock market. I will meet you again with the next guest. Thank you.
Thank you.
देखिए वॉरेन बफे तो अभी राकेश